we need to talk about tariffs. The US just announced a fresh round of tariffs on Canadian imports, and the ripple effects are about to hit our real estate market hard. Whether you're a homeowner, investor, or just trying to navigate the Canadian economy, this impacts you. Tariffs affect building materials, mortgage rates, home prices, and even job stability. And if you think that Calgary is immune, think again. This could reshape housing affordability, investor opportunities, and the rental market across Canada. Today, we're going to dive into what these tariffs actually mean for Canada, the impact on housing costs from materials to mortgages, which real estate market will get hit the hardest, and which might benefit. And stay until the end of the video where we're going to cover how you can position yourself for the best financial decisions moving forward. Let's start with what's happening. The US government just hit Canada with a 25% tariff on imports of steel, aluminum, and lumber, materials that are essential to construction. On top of that, they slapped a 10% tariff on Canadian energy exports. Canada relies heavily on trade with the US. Over 70% of our exports go south of the border. So when Washington imposes tariffs like this, our economy takes a hit. What's the motivation? Well, officially the US claims that they're protecting domestic industries, but let's be real. This is political maneuvering and Canada is in the crossfire.
Anyway, I started blasting. Bang!
So how does this affect Canadian real estate? Let's talk about the consequences. New construction could get a lot more expensive. Steel, lumber, and aluminum are the building blocks of every home. When tariffs increase costs, developers either pass those costs on to the consumer,
here, hold this,
or slow down new projects altogether. Expect new home prices to rise. Builders are facing 25% higher costs, so they're either going to absorb these losses, which is very unlikely,
thanks,
or pass them on. Renovations are also going to get pricier. If you're planning to add a basement suite or redo your kitchen, budget a ton more. Investors are facing shrinking margins, so the BRRRR strategy, buy, renovate, rent, refinance, and repeat, is becoming way riskier. But the ultimate question, will home prices actually increase? Well, this is where it gets tricky, and not because I'm a real estate agent. Normally, when building costs rise, home prices follow suit, but right now, supply and demand dynamics are shifting. Ontario and BC are seeing record high housing inventory. More homes on the market means buyers have more choices, which could limit price growth. Calgary remains more stable. Inventory is tighter and job growth kept demand strong. But the rental market may soften. With higher ownership costs, rental demand usually rises, but we're already seeing more rental supply flood the market. All right, if you've made it this far, you clearly are into this content, so do me a favor. Hit the like button, helps more people see this. And if you want more straight to the point real estate insights without the fluff, make sure to subscribe. I drop videos like this often, very often. I'd actually drop it more if I had more subscribers. So thank you for subbing. Inflation and mortgage rates are a dangerous combination. Tariffs often push up inflation, which means the Bank of Canada could delay rate cuts. If you're banking on lower mortgage rates, you might have to think again. Our best case scenario, we might see several rate cuts later this year, but a lot slower than expected. Worst case scenario, rates stay high or even go up as inflation gets out of control. For home buyers, this means borrowing remains expensive. The dream of getting that mortgage at 2%, probably not happening anytime soon. I still think that we're going to see 2 to 3 more rate drops this year because the economy as a whole is not strong and it's getting weaker by the month. Banks are already tightening lending rules. Mortgage delinquencies in Ontario hit a 10-year high. Mortgage origination surged 90% last year, but that's mostly because people were rushing to lock in rates before they get worse. If you're an investor trying to finance a deal, just expect a lot stricter lending criteria. Calgary does have a unique advantage. Unlike Toronto and Vancouver, Calgary's real estate market hasn't been completely overheated, and that's a good thing. Supply is lower overall, especially if we take condos out of the equation, which is keeping demand fairly stable. Rental demand is still strong, even though it's starting to slow. There's a lot less speculative investment in Calgary in 2025 compared to the previous years, which has seen our condo market slow down. Unlike Toronto, Calgary wasn't flooded with foreign investors. But here's the wild card. Energy tariffs. The energy tariffs could hurt Alberta. The US just imposed a 10% tariff on Canadian oil and gas exports. If oil demand drops, Alberta's job market could take a hit. If job losses start, housing demand in Calgary could weaken. But for now, Calgary remains relatively insulated, but if the tariffs persist, the economy could slow. Toronto and Vancouver have extremely high building costs and a high supply. Prices could stagnate or even continue to decline. Edmonton and Red Deer are very affordable markets, but they are reliant on Alberta's economy. And finally, Atlantic Canada is seeing slower immigration trends, which is going to translate into weaker rental demand. All right, so what's the game plan? Well, if you're a buyer, get pre-approved before the rates shift again. Prices may rise and mortgage rules could tighten. If you're a seller, consider listing at a more reasonable price before economic uncertainty grows. And if you're an investor, focus on cash flow and pay down, not appreciation. The days of easy flipping are gone across Canada. If you're a homeowner, lock up your mortgage rates ASAP. Bottom line, the market is changing and you can either adapt or get caught off guard.